Welcome back to Switzer and Australia's Business Channel. Treasury Wine Estates has been in the news as a takeover target, which at this point the company has repelled. But is it still in play? Our takeover guy, Tom Elliott, the Chief Investment Officer at Beulah Capital, has done his homework and there's a few other companies he thinks could be in the sights of those so-called predators. Tom, thanks for joining us.
Peter, good evening. Great to be here.
What's it like, Tom, living your life just looking around for businesses that are going to be victims of predators?
Well, I like to think it's a very interesting sort of life, but I mean, there's a very consistent pattern about companies that get taken over. I mean, usually they either had a previous bid, they might already have the predator on their register, or they might have another big shareholder who's desperate to get off the register, and they're the sort of person who sells to the predators. So we sort of comb through the shareholder registers of what we see as target companies, and that's how we come up with our list of stocks.
Yeah, you must get some interesting revelations at times.
Oh, look, you do. I mean, look, there are some stocks which throw up some real false flags. For example, Channel 10 has Takeover written all over it because you've got James Packer, Lachlan Murdoch, Gina Reinhardt, all there are substantial shareholders. But at the same time, it's in a terrible industry at the moment, as your two guests ago said. And so, you've also got to know to weed out the bad ones, to sometimes accept that maybe the strategic shareholders might have made a mistake when they bought their shares originally.
For sure. OK, let's start with Treasury, because that's been a big story in the news. What's your thinking there, Tom? Do you think they'll come back and make another offer?
Look, I reckon they will. Treasury's a very interesting business because it's got some wonderful brands. I mean, we all know about Penfolds. Penfolds is one of the few Australian brands, which is a global wine brand. Having said that, I mean, Treasury's cash flows, its ability to make profit out of wine has been absolutely terrible over the past few years. It does not surprise me that a predator, in this case KKR, has come in and said, well, we reckon we can do a better job. It probably means splitting up the Treasury wine portfolio. But you know what? A cynic would say that Foster's back in the old days should never have put this portfolio together in the first place, which they probably shouldn't have. So, yeah, I reckon, look, KKR doesn't need to rush in to lift its offer because I think the shareholders of Treasury will probably rush at KKR, but there's a lot of steps to go over next. And remember also, KKR has pulled out of bids before. It famously made a bid several years ago for Perpetual at $38 and then maybe $40 a share. The Perpetual board knocked it back. The share price slumped. Of course, now it's risen all the way back and then some.
Yeah, without a doubt. So, Tom, how would you play Treasury? Would you wait to maybe, like I know Charlie Aiken and a number of other people think there could be a bit of a sell-off on the stock market. Would it be wise to maybe wait for Treasury to come down a bit if you wanted to gamble on another KKR? Because if the share price went down, that's when KKR would probably come back.
Look, it probably would. My usual thing about this, and it sounds like we're having a bet both ways, but we usually, let's say whatever our desired holding of a stock like this would be, we would typically buy a third to a half as soon as the first bid is announced, and then we buy at our time with a bit of cash up our sleeve. So I think it's a very interesting situation. I don't think you'd want to be caught without a position because you don't want to wake up one morning and find that the bid's now $5.20 and it's been agreed by the board. It'll be too late then. I reckon you buy some shares now, wait for the market collapse, wait for some uncertainty, and then you buy some more.
OK, right. Let's go to your next takeover target.
Well, I've got a whole lot on the list here. One I really like at the moment, Spark Infrastructure surprised everybody last week. They bought 14% of Duet. Now, all these companies, a bit like SP Ausdent, they're either in the supply of gas or electricity via networks. Very regulated space of return, but therefore, a very solid dividend yield most of the time. Now, Spark, of course, having bought 14% of Duet, says, oh, no, of course, we have no current intention to make a takeover. But, I mean, no current intention could be changed at any time. And you could say, oh, well, we had no current intention yesterday, but now that we've woken up today, we do. Companies like that don't go and buy 14% of each other without having some sort of evil intention towards the target stock. So that's what I think is very, very interesting. And look, it goes without saying that you look at the fact that Investra had a bid by Australian Pipeline Trust. That bid has now been trumped by one of Investra's existing shareholders, CKI, a Hong Kong company, and we're waiting to see what happens in that one too. So that's a very interesting space, I think. Other ones I like, well, I guess a deal that's been announced, but we don't know where it's going to go yet, is David Jones and Woolworths. Now, David Jones is trading as though the Woolworths bid will definitely go through at this price, but there is still possible that Woolies might have to chuck a bit of extra cash on the table to get some shareholders on side. So, that's interesting as well. And I mean, you mentioned the retail space before. Obviously, retail confidence has been a bit battered in the week since the election, but let's be honest, the initial reaction after a harsh budget, if you do a vox pop or do a poll, is always terrible. I don't really think people are going to stop putting their hands in their pockets just because of what terrible Mr. Joe Hockey has done to them.
Okay, so just talk us through the David Jones Woolworths takeover. Is Woolworths going to take the entire company off the stock market, or are they going to be holding a majority share?
Well, that's a very good question, actually, because Woolworths actually still part owns a company I used to be associated with, Country Road. Country Road is still listed. Interestingly, Solomon Lew, the well-known Melbourne-based retailer, he owns about 11%. Woolworths owns about 88%, and there's about 1%, I think, still owned by a handful of staff. So it still trades. In this case, I don't think Woolworths would want the same thing to happen. They would like to buy David Jones lock, stock and barrel. And it is my belief, and I'm only basing this on what we saw happen with Myer several years ago when it was bought by private equity, they want to buy the entire company, sell off the very valuable CBD property portfolio that David Jones has in Melbourne, Sydney, and to a lesser extent Brisbane, and use that to help pay for the takeover, and then try and really turn around the retail operations to make some decent money out of them. But we've seen the script with Myer. I mean, Myer has had its asset base in Melbourne and Sydney completely transformed, and that has helped pay for the original acquisition.
Do you think Myer has become a takeover target by a foreign predator?
So Myer or David Jones?
No, Myer, because if Woolworths can do it to David Jones, why wouldn't another foreign department store look at Myer?
Oh, look, I think it's less likely because for the same, what I was just saying about the way you finance these retail bids is you unlock the underutilised value in the real estate. Yep. That's already happened with Myer, and so it can't happen again. It's a bit like Peter Costello coming back to pay down the deficit and the debt by selling off assets. All the assets he sold have been sold and can't come back. You couldn't do the same thing with Myer because it's already been done. All those property assets have been stripped out. But David Jones you can do it with simply because it hasn't been done before. So no, I don't see Myer as a target. I do see David Jones very much as the bid going through, but maybe at a slightly higher price.
Okay. Of all the companies you've mentioned tonight, which one do you think is the one that's most in play that viewers could make money on? We're not trying to put you on the spot, but the reality is which one do you think has more potential to go higher in terms of the share price?
You remind me of some of my talkback callers when they say, now, Tom, with the greatest respect, and what they really mean is, I don't respect you at all. OK, the one you can make the most money on is probably Duet, only because that's not a bid yet. That's where one company, Spark Infrastructure, has taken a stake in it. So that's got the most potential in it. However, you don't have a bid on the table to prevent any future losses. I guess, though, if I think about it, the two others would be Investra, because you've got two bidders there, Australian Pipeline Trust and CKI, and as we know, two bidders generally produces a better outcome for shareholders than one bidder. Yeah. And the other one I reckon would be Treasury Wine Estates and KKR. Now, KKR is not known for paying up, but the point is I reckon they wouldn't mind paying a bit extra to get this one, only because it's not unique, but it's very, very hard to find an international portfolio of assets that the TWE has. So they're the riskiest one with the highest profit, Duet, but those other two, I think, with takeovers on the boil already, probably have the best risk-return trade-off. If
you got stuck with Duet, you go long Duet and there's no takeover, are you still in a good company? Are you all reckoning? Well,
yes, and that's one of my absolute criteria. If you're going to buy a stock that doesn't have a bid on the table, but you think it will be bid for, that the fundamental rule is you must be happy to own the stock in the absence of a bid. Now, Duet has risen a bit ever since Spark bought its stake, but it's still got a very solid dividend yield. As you heard before, Saul Estlake doesn't reckon interest rates are going to go up until 2016. Buying companies with good dividend yields, as we're seeing with Telstra at the moment, isn't such a bad place to be. OK, Tom, last question. What is your view on the market? As I said, Charlie's putting a note out today, which will be in the Switzer Super Report tomorrow. He's a bit concerned that there could be a bit of a sell-off across June, July. What's your view? Yeah, well, I mean, for Charlie Aiken to turn bearish is a very bad sign because he's an uber bull most of the time. Yeah, look, I must say we are holding a bit of cash at the moment in the various portfolios that we look at. There could be a sell-off, but, you know, 10% of the absolute max and probably less than that. I mean, fundamentally, the world's actually in reasonable shape right now. So, yeah, a midwinter sell-off probably could happen, but that, in my view, would be a buying opportunity.
OK, well, one last thing. I got a question from a viewer, and he saw one of those websites, I think it could be a website called Money News, tipping a 50% fall in the stock market, and it went back to someone called Hyman who showed you how to place something like that. And I just felt to me like it was a setup for people to be scared and to read the article. Can you see anything like that, a major crash of the stock market on the horizon?
Oh, look, I can't, but, you know, then again, you know, no one saw the Berlin Wall coming down in 1989, but come down and did. No, look, at the moment, things are relatively benign. I mean, central banks around the world know what to do if confidence suddenly lapses. You know, they turn on the printing presses, they lower interest rates if they can go any lower. So, you know, we've been through the GFC. We're not going to see that sort of shock happen, at least for another generation. So, no, it's hard to see. But you know what, Peter, the one thing I would say is, remember the Japanese tsunami several years ago? I mean, that's the sort of thing that is unpredictable, but that put a real shudder through markets back then, and you cannot predict events like that. So, you know, like all predictions, forces of nature can overcome them.
Yeah, but it just seems to me that it's logical that maybe a 10 or even a 15% correction is a possibility because markets have done very, very well. And we know the Russell 2000's come down about 12%, but it went up 39% last year. So that's the kind of correction I can see, not these kind of Mark Faber, Harry Dent predictions of massive gloom. I just can't see the economic, even the financial reasons for it at this point in time.
Yeah, well, I love a quote I once heard about Mark Faber, and it's paraphrasing Paul Keating. He's predicted about 15 out of the last 3 stock market crashes.
Yes, exactly right. Tom, always great talking to you.
Peter, good to be with you too.
That's Tom Elliott from Beulah Capital. Of course, 3AW, broadcasters in the afternoons on 3AW or Drive. After the break, small businesses can be undone by shoddy products and or terrible sales. But what is going on with the selling of the budget? We'll be talking to the Small Business Minister next.